Hello, everybody. Just coming to you with the February financial planning update a few days early this month, given the situation going on in Ukraine at the moment. So I thought it would be wise just to bring everybody up to date and discuss a little bit how markets are coping, and more importantly, how the portfolios are coping with what's happening at the moment. Clearly, there's going to be some headlines today around market falls. We're probably going to see some fairly significant falls, especially on the FTSE today. So I thought it was wise just to address what's happening and discuss some of the things we're doing within portfolios to try and mitigate against the situation in Ukraine at the moment. First and foremost, just interesting to have a view of markets year to date. Now, it is important to point out that these figures go up to the close of trade on the 23rd of February. So we know that there will be some additional drops to come today. But very interesting to note that the FTSE 100, up until yesterday anyway, was still in positive territory year to date, whereas the S&P 500 in America, and of course, normally therefore the world market index, in quite significant negative territory, having already entered a technical correction, which is a 10% drop from a previous high. So a significant divergence there. And up until now, that's really been a reflection of the UK's more conservative status as a market. If you think about the companies that make up the UK market, they tend to be the slightly steadier and perhaps slightly more boring companies, but in volatile times, that can actually be very beneficial. And investors are seeking that safety at the moment. So perhaps the UK market is looking slightly more attractive than the mainstream US markets, which of course are heavily dominated now by the more speculative technology companies. The situation moving forward, of course, remains to be seen how things pan out with Russia and Ukraine. I think it's too early to say exactly what the scale of the conflict is going to be, but clearly some worrying pictures coming out of Ukraine on the news today. So in terms of how portfolios are behaving so far, balanced portfolio is now roughly about 5.4% down. This is year to date. So bearing in mind, we had a very, very strong year last year. So we do have to put these things in context. But the portfolio is really behaving precisely as intended in that they are limiting the damage in terms of what's going on in the wider stock market. And we do have to bear in mind that generally speaking, there will be assets in the portfolios that are designed to benefit in these sorts of situations. A lot of government bond assets have increased in price in recent days because they are deemed to be a more secure asset class. Now, of course, all of the headlines that we see will inevitably focus on the equity markets. But remember, most client portfolios will have at least a component of corporate or government bonds. And those are assets that are designed, hopefully, to fare better in this kind of environment, and they are designed to provide some degree of protection to portfolios. Now, looking at the Russian index, or a couple of different Russian indices, note the right-hand side of the graph here, just in the last week or so, that the very, very substantial sell-off. So up until only a few days ago, that the Russian markets were trading, almost flat year to date, and in the space of a week or so, we're now showing something like 25, in some cases 30% drops on the main Russian indices. So that's clearly a reflection of how the world views what's going on. And of course, the market is now starting to price in some of the potential sanctions against Russia. I think in the first instance that the concern for UK investors is more the impact that this will have on prices and supply chains. Already we're seeing the price of oil and gas increase very substantially. That's going to add additional pressure to family budgets, and they were already under pressure given recent energy price rises. So we can expect probably further increases to the cost of heating, utilities, petrol and fuel for our cars. And also food prices are forecast to increase as well. Of course, Ukraine and Russia being fairly major food producers in Europe as well. So all of that, of course, gives families less spending power, which is bad for businesses fundamentally. So we could start to see that having some impact. And I think perhaps from a financial perspective, certainly when we think about the mainstream global financial markets in the UK and the US, that might be the factor that actually plays a bigger part in the market falls that we're seeing. It's fear around the sort of peripheral impacts on markets, perhaps more so than the actual conflict happening in Ukraine and Russia. Now, although we, of course, have to caveat that the past is no guide to the future, I thought it'd be useful just to consider some historic geopolitical events that we've seen previously. Thanks to Vestra for sharing this analysis with us. But as we can see, by and large, these things are relatively short-lived. And in fact, that's true of the majority of market crises and market crashes. They tend to feel like they're taking forever at the time. But when we look at the graphs in a historical context, these things are often no more than a blip on the ever-increasing path of stock markets worldwide. So we can see here that, very often that the worst of the damage is done in the weeks leading up to the event taking place. And actually after the event, very often we start to see more substantial recovery. The two real exceptions you'll notice on the right-hand side of the table here are the two events in 2001, so that the September 11 attacks and the US air campaign in Afghanistan. In both cases, the 12-month figure was significantly negative. Do bear in mind that in addition to the 9/11 situation and what was going on in Afghanistan, we also had things like the dot-com bubble had just burst at that point. So there were other factors driving markets during that period in history as well. Contrast that with the items at the top, the Russian occupation in Crimea. Of course, that was on the news a few years ago, and the US airstrike in Iraq. And markets very, very strongly positive 12 months later. So it does go to show that these things can often be short-lived. Of course, we can't predict exactly how this particular issue will pan out, but suffice to say, we are monitoring things incredibly carefully. We're receiving regular communications from our investment providers, and of course, we'll be making tweaks to portfolios if we feel necessary. I hope that's proved useful and provides some reassurance given the situation at the moment. As always, if you have any questions about your portfolio, please do not hesitate to contact a member of the Buckingham Gate team. Thank you.